Hello everybody, it's me the Boss Hog. Today we're going to look at my portfolio. Title is The UK is turning red, both in relation to the state of the stock market and the direction of travel at the next general election. You have to suspect. We've got a new position, I've done a little bit of selling, so let's have a look. Let's do it. Alright, so honestly, a super red week. I don't even really know what to say. The UK market on Friday had a bit of a bounce, but broadly speaking, it was just pretty relentlessly red. I have done a new graph this week, so you can see in the bottom left there. This graph basically just shows the total value of my portfolio over time. You can see that basically for all of 2022, it's really struggled around the 100k mark. This was started in December 20, so you're looking at the better part of 2 years, and basically the figures are just recorded at month end. So the current figure here is midway through the month and is 101k. And yeah, that's currently where we are. So just the total value doesn't show profit or loss or anything like that. Again, it's one of many graphs, and we're just drip feeding each time we do this. I would say, just in terms of the relief rally that we had on Friday, it was pretty interesting, really, because we have a relief rally because 3 weeks ago we got a new prime minister, and basically our Chancellor of the Exchequer, so our finance minister, just got fired. Basically, what made the scapegoat, I suspect. And in a way, the market was relieved, but at the same time, it's just uncertainty all round at the moment. I think quite unimpressed with the state of UK politics at the moment, without meaning to go too far in that general direction. But definitely, it's pretty rough, and it's having a very significant impact on my UK holdings at the moment as well. They're all over the place. Last week, I did get absolutely battered on my UK stocks, so I suppose to only be down 140 quid is kind of okay, but not really feeling that, to be honest. What was good news is this week I decided to add another £800. That wasn't originally the plan. You might remember from last week that I basically expect to fall behind my targets across October and November. I'm changing jobs, we've got some big costs, etc. So I'm actually super happy that I was able to do another £800 this week. The impetus for that is that I now have a new job, so I'm going to be starting it in a few weeks, and that just made me feel like I was more comfortable about putting in a bit more from our cash reserves. So that was the main reason for that. And to be honest with you, I really wanted to buy whilst the market is so beaten up at the moment. Just the one dividend this week here for Medical Properties Trust. A fairly big one though. Honestly, I'm very happy to get it, and I've just put it straight back into Medical Properties, as we'll see very shortly. I did have a sale this week, the first time in absolutely ages. For anybody who hasn't watched my restricted trading video, it's actually quite difficult for me to sell shares. I basically have to ask my wife's employer, which is a private equity company, if I can sell, and then they have to approve it. So I decided to go through that process, experience it. It's kind of okay. And yeah, we'll talk about that in just a second. And last but not least, we already got ahead of ourselves with this one here on the graph. So without further ado, let's have a look at our buys, because actually there's quite a lot between what I sold and the new capital that I added. All right, so you can see here like 2.7k overall. In terms of the £800, this went into my personal ISA and was split evenly 4 ways. So between a consumer defensive company, SMT, so basically my tech play of choice, a clean energy fund, and the digital security as well. So just a bit of everything, broadly speaking. I would just say the digital security, I'm probably going to not put a ton more in, because my new position here, which we'll get to in just a second, has a lot of digital security in it. So both this and also ESPO, when we get to it, I expect to not become the 1.5% that I originally expected them to be, probably closer to 1%, as I sort of pivot into an ETF that I basically prefer and opened up a new position quite recently in. In terms of MPW, this is just reinvested, so nothing more to speak about there, other than the fact that I would say I consider MPW extremely cheap at the moment, so I'm very happy to be buying 7 shares a quarter at the current price. In terms of the additional funding that I was able to secure from the sell, so first of all, I opened up a new position in ATT. I'm actually going to look into those this week, so explain to you why I did it, but effectively it's kind of a big tech mixed with a software and digital security ETF. It's actually fairly light on technology segments that I'm very heavy in, including things like semiconductors. So it's very complementary, and also they have a lot of like big tech in terms of their largest holdings. And although I'm quite heavy on tech, like I don't have huge exposure to the big tech. I've got like 1,000 in Amazon, about 1,500 in Microsoft. Like just over 1% basically in the big tech. So for me, it's a very complementary ETF. And again, we'll do a dive into that in a few minutes. Outside of that, I put £400 in my REIT ETF TRET. and my Canadian one, HCAN. Again, I really like both of these ETFs, especially TRET. I'm really adding as much into that as I can. I think REITs are a bit beaten up at the moment, and I do understand why, but I also think they're very inflation resistant, as well as have some resistance to increasing base rates as well. So that was my rationale there. GDIG has turned red for the first time in a few weeks, so I decided to average down on that of 200. So this is my mining play basically. And then £100 in ESPO. Again, I don't expect this to be a huge ETF for me, but I wanted to take the chance to average down into my esports exposure as well. So that was my rationale there, basically. So that's a walkthrough again. Most of these are just ETFs that I'm buying, but a new position in ATT, which we're going to dive into in just a second. But before we get to that and my broader portfolio, let's have a look at what I sold. Okay, so yeah, I did sell about 40% of my Huntington Bank share position. Honestly, nothing wrong with HBAN, and in fact, there was some pleasing numbers from some of the American banks that were doing updates. For me, the main reason here was because I wanted to increase my exposure into the REIT ETF and my Canadian ETF, as well as open up a position in ATT. Actually, with somebody from the Discord group that highlighted this about 4 weeks ago to me. And yeah, the more I started to look into it, the more I just realized it's incredibly complementary. So again, I wanted to kind of use a bit of a capital injection, and half of this basically went in that direction to ATT, as well as, like I say, beefing up my exposure to ETFs that I like, and pay dividends and look cheap and etc. So that was my rationale here. So I still have a fairly chunky position in HBAN, but obviously now it's much reduced as a result of that. So that's a decision there. All right, so standard stuff here. This is my full portfolio breakdown. I share it every week, and then we just do a week on week change basically. The stuff that I've highlighted green are the things I want to talk about. But the standard stuff, if anyone wants to ask me questions about any other holdings, or indeed holdings I don't have, but they do want an opinion of, then feel free in the comment section. Without further ado though, so I'm going to start with MPW. I remain really bullish on this. Like, I'm down the better part of 30% at the moment, but for me, if I was still buying individual shares, it's a real slam dunk buy. I think the bear positions are massively overblown. It did have a pretty good write-up on Seeking Alpha that basically mirrored my thoughts on the matter. Again, bearish positions overdone. Yeah, it's had a few challenges, but etc. etc. Nothing to worry about really. Both that article and the general news this week as well flagged the fact that MPW is just committed to a very large buyback, basically up to about 8.5% of its market cap. I'm really pleased to hear that. I actually want to see buybacks from a few companies in my portfolio. Like, I think the share price is so beaten up at the moment that actually it's a good use of funds to return shareholder value with buybacks. And for me, because I personally believe that MPW is about half price at the moment, I think it should be like $21, $22. For me, the fact that the company wants to be buying shares at $11 is a perfectly acceptable use of money for me, and I want to see more of it. So that helped midweek. Gave the company a bit of a floor. I would also point out as well that Chuck's video from Fast Graphs was very complimentary, I would say, on the business as well. He arrived at a similar price point to me, which is slightly above market consensus, but not massively. And again, I think he's even more bullish than I am. I think that's probably fair to say. But I'm not far behind. Like I say, I think this is a $21, $22 share price that is fundamentally misunderstood. And the way I like to explain it to people is it's similar-ish in a way to Vici. I think, again, another stock that was historically not well understood, bit of a niche play, but you're looking here at like marquee sites that are difficult to replace, that tend to at least preserve their value, where the REIT owns the assets, so if the tenant goes bankrupt, it's fine, you just give it to another tenant. And because of the location and the marquee nature of big hospitals, it's not so easy to replace them or not buy them again. They're kind of needed, right? That's why they're built in the first place. So I think although this is in like the healthcare REIT sector, I don't think it compares very easily to things like nursing homes, which are very different business models. So most of MPW's tenants are fine. Stewart, I think, has been well reported and I think is overblown. And again, I think the nature of MPW's niche means that it's perfectly reasonable that it's investing in a different way that like Realty Income would, right? Which is absolutely a generalist, and that's fine too. So for me, I just think MPW trades on incredibly cheap multiples at the moment and is a screaming buy, is my position here. And I mean, finally got a little bit of love. I still think it's massively undervalued. And again, for me, it was very easy, therefore, to put my dividend back into it. In terms of PHNX and LGEN, they took slightly different paths this week. They continue to be kicked around as the UK government, I can't think of a charitable word here, continues to mess around. I would also add that the Bank of England decided to also, I don't even know, like play politics this week by making very public announcements that were very obviously not going to cause stability in markets that they're meant to be regulating. So basically, you've had the Bank of England and Conservative government having arguments with each other and more or less playing chicken, and that's just playing havoc on long-term insurers. I would point out an article that was released this week that basically argued that UK insurers, particularly with exposure to the life insurance, so this really affects PHNX, but also to some degree legal in general. A lot of the maths that's used in terms of like accounting for long-term liabilities, this article is arguing is basically too conservative at the moment and hasn't been reflected in the share price of life insurance insurers. The reason for that is because there was this expectation that life expectancy would continue to increase. And actually, that's not really what we're seeing. Everything from sort of COVID to different changes in lifestyles and diets have kind of meant that, we're not all living to 100, right? Actually, lifestyle changes has decreased life expectancy, which is ultimately good for insurers, right? It more or less increases their insurance margins. So it doesn't impact their float investments, right? The other way that insurers make money. But in terms of your actual underwriting, this is really positive, especially for life insurers. So I thought that was an interesting point of view, and we'll see how that shakes up, but just something for everyone to consider, I think. I've teased this a little bit. It's going to be straight after this, so bear with me and we'll have a deep dive into ATT. But I also want to talk about Hollywood Bowl. You might recall last week I was somewhat nervous because I was expecting a trading update on the 7th. It came out on the 10th, so a day later than I was expecting. I'm not really sure why. No one seemed to worry. And again, I did find other sources that originally were expecting this on the 7th, so very weird. It's definitely a penny stock, so we'll forgive it. And actually, to be fair, as you'll see, the trading update was decent in my opinion. Not that it received any love whatsoever in a difficult market. You can see here it fell 5%. I was personally very happy. It did go up immediately after publicizing the results, but then it went back down again. So who knows, I guess. So anyway, we're going to have a look at both ATT and Bowl next. Let's do it. All right, so first of all, this is a relatively small fund, just over $1 billion. It was as high as $1.5 billion at the end of last year, but with tech exposure and this year being what it is, it's back down to $104 billion. It's a relatively deep, not broad ETF. It's only got 47 positions. And now, in fairness, no matter how much I tried here, Allianz only seemed to publish the top 10 of their portfolio, which is really frustrating. Normally, I do a top 20, of course, for anyone who's followed me. But the top 10 here is fine. It accounts for just under half of the portfolio. And again, the portfolio actually has close to 10% in cash at the moment, which is also pretty interesting. They're holding back a reasonable amount. And basically building up a cash reserve as far as I can tell. It does not pay a dividend. Any dividend it receives from its holdings is just reinvested. I do suspect here, looking at the companies, that the dividend isn't massive. Other than Broadcom, most of these companies are either not paying dividends or paying very modest dividends. And that's okay, right? It's a tech fund. For me, I actually prefer my US holdings to not pay dividends because I get taxed on them, and my UK holdings to pay dividends, but ultimately I'm fairly agnostic. It just goes straight back into my investments anyway, so it doesn't matter too much. I do like buybacks just because I dream of owning more of the business, but that's fine, right? This is what the company is basically doing. It's getting this dividend and then it's reinvesting them. The management fees are reasonably high, and I've done 2 asterisks here for basically 2 reasons. First of all, they have a relatively complex management fee structure where basically they have 4 different bandings. So depending on how much assets under management they have, it basically starts at 0.8% and then goes down to 0.5%. So basically anything over $1 billion in management is only management fees of 0.5, and ultimately the 0.69 here is what we're paying based on last year's position. So there is some variability in the management fees here. As this fund grows, we should basically end up paying less management fees. So be aware. There is also a performance bonus, so it's capped at 1.25%, so pretty hefty, although they do have to beat the benchmark by 10%. to start qualifying for that. So I would actually be relatively happy if my ETF beat its benchmark by more than 10%. I would almost say that that deserves a bonus of some description. So again, there is some variability here in terms of the management fees plus the performance fees, which might discourage people who like that certainty or have some sort of objection to either of those fee structures. For me, again, I would say the fees here are relatively high. It has had very historic overperformance, and Morningstar, as you'll see in a second, still loves it. It thinks it's really good. Probably the best write-up from Morningstar of any ETF I've looked at. I'll divert the attention to the top right chart here, which is basically showing the fund's performance against its benchmarks. So I think it's interesting. It's definitely outperformed, especially over the last few years, although it's gradually being pulled back in a falling market. So think of that what you will. In terms of its trading, it's trading at a chunky discount against net asset value. So I looked at a lot into this when I was looking at SMT, because I thought to myself, well, maybe that's explainable because of its private holdings, right? But Alliance doesn't really have, ATT doesn't really have that same level of exposure. And to me, it's really driven by sentiment. And that's what the graph in the sort of middle right here above my head points out, that this is trading historically a discount against its net asset value by close to 15%. So yeah, to me, again, that's just another reason to buy it. I liked this. This is a really good description from it's being written by the fund manager himself, so the actual individual who manages this fund. And I like this as a description as to really why I wanted to buy this position. So basically, they are overweight in automobiles, IT services, and software, and underweight in hardware, media, and semiconductors relative to the benchmark. And for me, this is really good because I don't have any automobiles other than maybe like some things like chip makers and some chemical companies that do like dashboards and stuff, right? But really no exposure to automobiles. IT services, yeah, okay, I have some, but again, they're fairly complementary when you actually look at the individual companies. Software companies here, like I had to actually look up a few of these companies that I'd literally never heard of before. And again, I would point out here, not just software. For me, the real standout is actually the cybersecurity stuff. And things like software optimization as well is like a big thing, which again, I've worked in telecoms. There's quite a lot of overlap, and some categorizations will include things like tech, telecoms, and media, right? TTM is definitely a recognized abbreviation. The consultancy companies love TTM. So yeah, for me, I don't have a ton of exposure in those software areas. And likewise, I'm very heavy in things, well, especially semiconductors here. And even like some of my IT companies, like the likes of Apple or Microsoft, still have huge revenue streams from hardware. Media, I've tried to play around with media companies before investments, and it's just never gone well. I don't really understand media companies, and I don't really have too much interest in them, to be honest. So I'm fine with being underweight here. So for me here, the main rationale is, again, it kind of fits in very nicely with my main approach to buying ETFs at the moment, which is to complement my existing holdings. And even though I have a very chunky exposure to tech, and you can see here, like right, 3/4 of the fund is basically tech, it doesn't feel like I'm duplicating much of the buys here. And even though this fund is obviously top heavy, like 20% between the big three, again, for me, it's fine. I wanted exposure to big tech anyway, and I don't have a ton. And then, there's a lot of stuff in here that I probably wouldn't consider buying. And even things like Broadcom, right? It's like main semiconductor play, and TSM. I don't have either of those in my semiconductor holdings at the moment. So again, it just felt very complementary from that perspective. I don't really get any geographic wins here. You can see it's very weighted toward North America. So there's no real benefit from either a kind of specific segment or specific geographic region. The main benefit is the fact that it's a very tech-specific complementary, as well as, I guess you could argue, in terms of the size of tech complementary. But again, that's just that's like a specific of the fact that the tech just fits together very nicely. In terms of its performance, it's been all over the place. Now, if you look at Alliance Technology Trust website, they only show this compounds, but instead I've broken it down and double checked these numbers against Morningstar to give you a per year number, basically, because yeah, they won't show you the per year number. That you'll get something slightly different straight from the website. But if you look at Morningstar, they'll have these same numbers. So I've gone with that as well. But you can see here the last year has been pretty rough. This is definitely similar, if not worse, than some of the benchmarks. If you look at the Nasdaq, these are similar kind of numbers. So again, here I think like you can look at this and take a very visceral reaction of like, but again, against the wider fall in the positions that this company has, I think it makes a ton of sense, and I'm not particularly concerned. And for me, I'd rather look at the long-term performance and the underlying rationale rather than what's fairly short-term here. And again, when I think about tech, I'm thinking of like 3 to 5 years, and my own investment horizon is 20 years. So again, I'm not really too concerned with the red here, which is obviously quite high. But again, I'm fine with that, so that's okay. Yeah, last but not least, like I say, Morningstar loves this over basically any time horizon, whether it's like 1, 3, 5, or 10 years, it's 5 stars across the board. It points out this is large growth focused. So again, it tends to buy larger companies, but companies that are growing in the tech sector. So that's fine. So yeah, I discovered this from basically a name drop from somebody in Discord, but the more I looked into it, the more I realized it was very complimentary to me. There are definitely some things I wish weren't the case here, like the relatively high management fees, which can then be even higher depending on certain things. But I like to me, this feels like an excellent buying opportunity. Like I'm basically going to shovel as much money into this ETF as quickly as I can. And it may well end up a fairly sizable chunk of my portfolio, just because to me it kind of enables me to buy less of my digital security ETF, as well as potentially my esports ETF, which although you wouldn't think they were that complementary, if you guys have seen my review of that ESPO ETF, you'll realize there's a lot of non-esports stuff in that. It's a bit of a strange one. So for me, yeah, I kind of view this as a better ETF for me. It makes me feel better about buying it. It's a lot more well-rounded. Its companies are, even though not all of them are profitable, it's clear that they're huge companies going in the right direction. And again, it fits very nicely with my portfolio. So that was my thinking here, basically. So again, I plan to be buying a lot more of this as soon as possible. Let's have a look at Bowl now. All right, so just to be clear, this was a trading update rather than full results. I'm expecting the detail of the full results in about 6 weeks. When that comes out, I'll be very happy to bring it to you. For anyone who's newish to my channel, you may or may not be aware, but I did a deep dive into Hollywood Bowl about 6 months ago, and I was actually very pleased because my expectations for the full year are pretty close. I mean, bang on basically in both the revenue, the dividend, the profit expectations, and those expectations from me were slightly ahead of the market. So for me, it kind of indicates the Hollywood Bowl did outperform over the last 6 months. A period of time over summer, which is normally not particularly great for bowling alleys, right? People want to go out in the sun. However, a combination of sort of flight disruption and actually the weather being so hot that it kind of discouraged people from going outside in 40-degree heat in the UK, and instead would prefer air-conditioned alleys and nice food and drink. And its main competitor, 10 Entertainment Group, saw exactly the same. So I was expecting a relatively positive update here, and to be honest with you, that's basically what we got. So a lot of the comparables are against financial year 19, so that's before lockdowns, etc., which I think makes sense. Hollywood Bowl has been able to maintain profitability over the last few years despite the lockdowns, but part of that was just how their financial year falls. I think you could easily take like a 12-month period within financial years, or crossing over, and you would see differently. But important for me here is the comparison, the fact that the business is basically back. It's all up and running. It's business as usual. And when it comes to my pricing expectation, I've actually returned its multiple to what I think is a long-term fair video. Whereas when I last did this 6 months ago, I gave it a slight discount because of that uncertainty, which I no longer think applies. So plus 42% against that comparable. Most of its revenue still comes from the UK here. The £6 million that doesn't is from Canada. They recently made an acquisition in Canada, a company that did both supplying other bowling alleys as well as having 5 of its own, although they've added an additional one over there since. But the majority, this is effectively a UK business which is in the very early stages of international expansion. LFL growth here, which is basically average spend per game, is up 28%. Again, this is really pleasing for me. This is a relatively difficult measure to compare against 10 Entertainment, because 10 could do theirs on average spend per customer, whereas Bowl do theirs on average spend per game. So you have to be mindful of the difference between those two figures. 10's number is better, but of course Bowl's is less, but then the average person plays close to 2 games, so you kind of have to factor that in. Like really here, my average spend per customer for a Hollywood Bowl is about 21, 22 pounds, whereas 10 is like 15. So to me, again, this indicates it's a better business. Basically, it's more profitable and it's larger, and there are some other benefits that we'll get to in a second. But broadly speaking, moving in the right direction. They use EBITDA as their primary profit measure rather than net profit. I think they should probably change to net profit, honestly, but fine, we'll go with EBITDA if that's what they're using. And here they said it's going to be at least 40% compared to financial year 19. Again, we'll wait to see the details, but I'm expecting pretty positive here as they basically maximize their revenue for reasons, again, we'll get into in just a second, and also reduce their costs. So they're basically becoming, to me, a more profitable business, which is better run. They've reinstated their dividends. So previously we had an interim dividends. They maintain that their target here is to pay out 50% of their profit into dividends. That's what they were doing pre-lockdowns. That's what they'd like to get back to. So they did a 3p dividend earlier in the year, and they advised their final dividend will be 7.5p. Now I'm expecting 8p here. That's the figure that I had based on, 8 plus 3 was 11. And then that would be 50% of the EPS being 22p. So that's my expectation. They're saying at least 7.5, so we're pretty close here. And again, I'd like to see 8, but we'll see. It will basically be dependent on what their EPS is as to how much dividend we get. But it will be 50% for the full year, as in interim plus final. So we'll see what that figure looks like in a few weeks when the numbers are published. But this to me now is a really good yielding stock, right? Even at 10.5p, you're looking at a share price less than £2. So you're looking at an easy 5 and a bit % dividend here from a stable, growing company, which is extremely strong balance sheet. So yeah, it's basically a super safe dividend as things stand. Net cash also rose. This is despite the fact that they spent 10 million on the new Canadian business. Again, lots of money now coming back into the business. They do have an undrawn credit facility available to them until the end of 2024. The way the business is run, it's quite conservative, but I think they kind of want it on the balance sheet just in case opportunities are available. That's okay. Again, to me, this business is still at the growth end of things. So, I want them to be able to pick up a new business in Canada or to be able to buy a site from a distressed rival in the UK, right? These kind of things. The bowling alleys they tend to have, they're not vast, but they're not small either. You're looking at a couple of million per site as a kind of average quick and dirty calculation, right? That's roughly what they had in Canada as well. So again, this gives them actually a lot of firepower considering that they have about 60 alleys at the moment. So, I mean, they could add another like 25 on top of that relatively easily and relatively quickly if they identified those opportunities to do so. I've mentioned this beforehand, but because of the nature of the business being very conservative, they hedge their electricity to the end of 2024. Now they've actually added to their hedge since then, and in the meantime, they're basically putting solar panels onto all of their centres. So that's continuing rapidly. Basically, I expect that by the end of 2024, unless it's not possible to do so, every one of their centres will be fully powered by solar. So that's the general direction of travel. Obviously, I say fully powered when the sun is shining and they're able to generate electricity that way. But they're basically going to have a ceiling on their electricity costs in the meanwhile. So that to me is pleasing. Also as well, they derive a fair amount of their revenue from food and drink. Roughly 50% of their revenue is from non-bowling. So that's a combination of food and drink and arcades. But less than 10% of their costs are from food and drink. And even then they took steps to simplify the menu, streamline suppliers, kind of just to really eke out, make sure that they're having strict cost management there. And, staff costs account for 20% of total revenue, which is fine. They also point out things like internal development, that they have the best bonus scheme, that they've had a couple of pay rises, as well as a cost of living bonus for their staff. And the results that they publish in terms of customer engagement and employee engagements are really great. I've made this comment beforehand that the business is a surprisingly digital first offering from a bowling alley. They have millions of customers in their CRM system. They have dynamic pricing so that they can really optimize, right? That to me was also another big difference between Bowl and 10 Entertainment. 10 Entertainment basically had to reduce their pricing. And in fairness, I don't hate the business model at all because
like once you get people in the door, the margins in bowling alleys are actually really good. So, you know, like that was their approach. But Hollywood Bowl have really good locations on the whole and didn't feel the need to basically enter into that approach, which to me is fine. I think both approaches have some validity, but I think Hollywood Bowls is a little bit smarter, and they have that sort of tech to enable them to do it. So their plans basically moving forward to expand from 67 sites to 110, at least 110 over the next decade. Again, I wouldn't say that that's particularly ambitious, but it's also not super slow either. So you know you're looking at basically 5 a year. So you can kind of see here when they're sitting on so much cash, it is worth consideration. And by the way, that cash represents about 20% of their market value, so their market cap. So again, like this is something else to consider, right? When you actually start to look at multiples in terms of your earnings, that they're sitting on a huge amount of cash relative to the size of the business. So one of my wishes for Hollywood Bowl is that they'd be slightly more ambitious. But again, I think you have to, you know, if you want a safer play in terms of the penny stock territory, right, you're looking at like 300 million in terms of this company enterprise value. So it's like, you know, if you want a not hair-raising, you know, make you have a nervous breakdown penny stock, this is profitable. It's been a listed company now for about 7 years. There are worse places to put your money in terms of like thinking about a growth company for the next decade. This is kind of it, to be honest. Next up, they continue to focus on upgrading. So I've already mentioned about the digital offering, but one of their kind of more technological, interesting things is pins on strings. So instead of having to wait for everything to be re-racked, basically goes up into the ceiling and then it's ready to go much quicker. So what that effectively means is they can have more games per hour at a alley with capacity. So, you know, again, it just enables them to further eke out wins. And the other benefit as well is not just capacity, it's like time sensitive. So something that they talk about is the fact that like they have the best offering for a family of 4, right? Family of 4 can have a game for like 20 quid. The other thing I would highlight is time sensitive families, right? Like I became a father quite recently, and like time becomes much more valuable when you've got a little kid who has a very short attention span. So being able to eke out a second game or a third game could just potentially, you know, add that few extra quid if you think about the fact that, like, you know, you've only got half an hour as a family. So again, to me, this is a good thing. They expect to have this all completed by the end of 2024. I don't know actually if that includes their Canadian arm or not. I suspect it's actually just their UK offering because the rest of it spoke about UK. But again, this is a UK dominated business at the moment. I think I've mentioned all of this already, so I don't want to touch on it any further. And for me here, I'm basically happy to stand by the guidance I set in May. I think it was actually pretty bang on and actually better than the market, so that makes me feel pretty good. I expect EPS to be around 22p. And I've decided to increase my target price here for the shares to 330. I would still point out that that isn't particularly ambitious compared to the wider market. A lot of the pricing at the moment is anywhere between about 300 and 450. For me, I'm basically just doing a very simple bit of maths here, and I've decided to give them a P of 15. I think that's a fair, I mean, a P, like giving something a future PE is kind of arbitrary, but I've done this for 2 reasons. First of all, I think it's a perfectly normal PE. And it's defensible. And secondly, this is what they were trading at before lockdowns, etc. So I think the fact that the business has returned to normal, whereas in May there was still that risk, so I gave them a 10% basically premium, right? I only gave them a multiple of 13.5. Now I think 15 is much more reasonable. Again, they sit on tons of cash as well as a nice incentive, and you'll be getting a nice dividend even at these kind of levels. As well. So I think for me it's a 330p share price. So, you know, anything under £2 here for me is an absolute screaming buy. I feel very good about my average at 216. So I am red at the moment. I'm red on most of my holdings at the moment. But, you know, I feel really good about Hollywood Bowl. I think it's a really strong business. I think bowling in general is a really resilient family activity that's going to hold up despite cost increases everywhere basically in the economy. Bowling alleys are very margin, you know, high margins. You just have to get people through the door. And Bowl has like really nice atmospheres, really good branding, a really good little business, honestly. And I think it was overlooked from the trading updates, which were running at least slightly ahead of expectations. And I think where it's trading just is really dirt cheap at the moment. You're picking up like a 9 on current PE and something like a 6.5 on future PE. and that to me just looks like a real discount. So yeah, that I think it's a real strong buy. And so yeah, two strong conviction plays for me this week. One new position, one I've had for quite a while, but I still really strongly believe in it. Anyway, I don't know whether you agree with me. I'm happy to have arguments or to hear that everyone agrees. That would be nice, wouldn't it? But without further ado, let's finish it there. It's half an hour video already. So thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.